Yeah, it's
Yeah.
nice to have you here. Let me oh, okay, this is pretty fancy. Nice.
Oh
I'm
yeah,
liking the
no, I
presentation
had to do
here.
a big intro. I had to do the
Uh-huh.
big intro. Yeah. Um,
Cool. Nice, nice.
yeah.
So yeah, let's for everybody who's joining in for the first time, this is the second Slayer Talks. So we're bringing traders, infrastructure builders to explain what they're doing, what they've learned, their own stories, and most of all, how you can improve as a trader. Um, so I'm Ekin. I'm from Chainslayer. We have a community called Slayer Chat, and what we do is we build trading infra, and nowadays also doing these webinars, and we're getting awesome guests. So today we have Mako Algo or Matic. I don't know what to call you,
Yeah,
but
it's yeah, I know in crypto I go by Mako Algo, but in real life I'm Matisse and yeah, either of those is fine. I guess I'm used to either of them. Um
cool. Yeah, and
yeah,
where you pronounce
that's
it Matisse?
yeah. It's that's happens when you leave in uh, Slovenia essentially. So it's yeah, it's not English pronunciation. It's closer to Russian. So
Mm, cool. Okay, never been there.
yeah,
But I hear it gets cold during the winters. Not sure if it's true.
yeah, it does get cold. It is already cold. It's thankfully I have
Ooh,
to stay inside. Otherwise, yeah.
yeah, yeah. I'd say
But
I'm
yeah.
in Helsinki now, so we're below zero. I feel you on
Okay.
that.
Yeah.
Yeah.
All right.
Okay, but hey, yeah, I don't know. I guess you got a lot of stuff prepared here. It's looking good, so
Yeah.
maybe.
Let's get this going for sure.
Yeah, let's get it going, man.
Yeah,
By the way,
definitely.
for
All
the
right. So
audience, right before we start, sorry, I'll just interrupt for a second. So you guys
yeah.
can at any time write questions either in the chat or there's a QA box in the well in the Zoom in the bottom there's a QA. So if you guys have any questions, just put it there. We'll pick it up over the presentation, and you know, yeah. So just to let you guys know that's we want to keep it kind of interactive, and towards the end we can have like a AMA session. So then if there's other questions that didn't get addressed, we'll do it at least by the end. Okay. Yeah. Sorry about that. I just wanted to mention that
All
for
right.
for
Yeah.
people.
No worries. No worries. No worries. All right. Yeah. So this is kind of the agenda that I intend to kind of follow today. I'll start with who I am, and then what is arbitrage for those who don't know, and then also why we would potentially want to use it, and then also obviously how we would use it and how to implement it and stuff like that. And then finish out at the end. We'll finish with kind of the open questions, the stuff that I didn't cover today, and maybe where to go from here. All right, so who am I? Well, most of you probably know me as the creator of AlphaBot, which is the famous, I guess famous, crypto and stocks charting bot for Discord. But before I kind of started working on that, I've been developing iOS applications. I've been doing that for about 3 years, and I've created Helios, which is a magic hour calculator, which is essentially app for photographers, and it's been pretty popular. And then as soon as Bitcoin kind of started picking up, I've started researching Bitcoin in 2017, and then obviously proceeded to buy Bitcoin at the very top, as one would expect. Sounded like a great idea at the time, so I did that. But I soon learned that I actually not really the best guy at manual trading. So I kind of pretty soon started researching algorithmic trading, and I've been working on that ever since. I've really done everything from price action strategies to order flow. I've Dutch market making as well. And right now I've been working on arbitrage systems. And, this is basically what I've been doing recently, mostly. So I think that basically covers the who am I. Not really that important. So let's just get going. So what is arbitrage? Well, according to Investopedia, this is simply a strategy that profits by exploiting the pricing inefficiencies of identical or similar financial instruments. So as an example, let's say that we observe a price on the exchange and we see that a certain instrument is priced at $124.15. And then at the same time, we observe the same asset be priced at 5 cents higher on another exchange. And what we can then do is simply buy 10 contracts on the first exchange and then go and sell those 10 contracts on another exchange. And there we go. We've just made 50 cents of profit. And it's essentially free money if you do it really fast. It's also pretty low risk. But there is one major problem with this kind of approach, which is that if you're not the first guy to kind of make the trade, you are unlikely to be able to profit from that. Because when the first trade comes in, you will that trade will likely move the price. And when your trade comes in, let's say your second, you're going to observe a price that's, you're going to try to make a trade that is done on a price that's like no, it's not there anymore, right? So you cannot profit from that. So really key in those kind of simple strategies is that you're really fast. And we're going to assume that we're not really that fast. So that's kind of where statistical arbitrage comes in, where speed is not really that much important. So kind of fixes that problem. There are other forms of arbitrage as well. You have triangular arbitrage, which is similar to the example I gave, but instead of just using one instrument, you kind of have three and do a trade in a triangular form and stuff like that. But not really that important either. As long as we understand that statistical arbitrage uses pricing inefficiencies, that's just enough. So that covers that. But you may be asking why. Like, why would we use this at any point instead of something else? And that's a good question. And I've made a short list of popular strategies. Something like something that others could use. For example, moving average crossover strategies, combine multiple indicators, and so on. So let's take a look at those and see what's going on and why we potentially may not want to use them. Well, moving average crossover strategies are fine if you're just starting out. They're a good start just to get an idea of how the markets work. But in the long run, you're likely going to find out that your strategy is not really sustainable. That you're going to easily overfit the strategy, which essentially means that you'll find a set of parameters that work, but they kind of stop working after a bit. So yeah, this is really not going to work. This is not really. I don't advise you to put your money on that. But if you're just starting out, of course, it's a good starting point for just all the algo trading related stuff. All right. Well, what about combining multiple indicators and kind of using that to filter your signals and maybe get a better signal from that? Well, you're kind of still inheriting the same problems as you would with the moving average strategy, but now you just have more of them. You still have to find a set of parameters that work, and you're likely going to overfit the strategy. So this is again not really the best way to make a strategy. So we'll not use that either. But it's at least a start. Next up, we have dollar cost averaging, and surprisingly, that is actually going to work. Now, why? Well, there's a meme going around crypto Twitter, and it's basically saying that like the number is going to go up eventually. And it is true. I mean, considering past data, Bitcoin does seem to have certain cycles and creates higher highs. So if you just bet on that and keep buying for a long period of time and kind of averaging in, are actually going to maybe be profitable at the end. But this is simple enough and really no point in kind of explaining that in much more detail. But yeah, it should give you um, profit at the end.
Wait, if somebody doesn't know the kind of the dollar cost averaging term, like how does it work? Just kind of a really practical example.
Yeah, so dollar cost averaging essentially means that you enter into a position over a long period of time. So in simplest terms, that just means that you'll buy an asset every day and just keep doing that for a really long time. It's not really that complex, and it's pretty similar to buy and hold, but statistically, it will give you a better entry um, than
Mm.
uh, just buying at one point and then holding that, because you're unlikely to buy at the lowest point, right? Dollar cost
Yeah.
averaging at least gets you closer. So that's kind of the idea of dollar cost averaging.
Okay, cool.
So yeah, all right. So going forward, we have overflow strategies in market making. So these are pretty fancy strategies, and they are definitely going to work. But they have a pretty high entry point. Like you need to have a good understanding of how markets work, what data you're kind of able to get, and what that data means. So it's not really all that simple to begin making such a strategy. But if done right, like you're almost certainly going to be able to make profit. So this is not really a topic that we'll be discussing today, because there's a complex, and arbitrage in theory is much simpler. So yeah, we're back at statistical arbitrage. Um, so I guess now we're getting to the good parts, which is how do we actually get this to work? Well, we have to start somewhere. So let's just start with a simple chart. This is Apple's stock closing price on the daily time frame over the past 5 years. So quite a lot of data, but we can see that this price really does a lot of random stuff. It's always jaggy, and it doesn't start there. It kind of goes sideways and then starts picking up speed, and at some random point it just decides to go down again, and then reverts, and goes up even more, and at the end there it actually kind of looks to be undecided as to which direction to pick. And yeah, this seems pretty random and pretty hard to predict. So we're not really going to do that. I guess some people would say, yo, but you could use technical analysis on this and then try to predict the price with that. But I don't really have a good opinion about technical analysis, unfortunately. There is no really quantifiable proof that technical analysis works. It works for some people though, but there is with technical analysis there is always some discretionary factor involved in actually making it work. But we cannot put that discretion into an algorithm, so we cannot automate it. So that's really not useful for us. So yeah, we're not going to use technical analysis. But we can't just predict this price either. So what we want here is something that is mean reverting. So mean reverting essentially means that some data set is going to oscillate around some kind of average. In terms of prices, this basically means that the price will oscillate around a fixed value. But how do we get some data series from a price that is mean reverting? Well, we can
What
take
do
the
you?
differences
Sorry,
between.
quick interruption. Quick
Yeah,
interruption. So, what do you mean
sure.
with like the price oscillates around a fixed value? Like, what does it mean to like oscillate,
Yeah,
and what's the
well,
fixed value?
right. We'll get to that in a second. I have
Okay.
a chart on the next slide. We'll get to that.
Mm-hmm.
Um, so the idea of how do we even get that is we take the differences between the current candle close and the previous candle close, and we just plot that. And this is exactly what we'll do. And we can kind of see here that the price looks kind of noisy, or I guess this new data set looks kind of noisy, and we can see that it oscillates around 1. Um, if we average
Yeah.
all of those price movement over the entire period, we would get something that is pretty close to 1. And
Oh,
so
so
yeah,
this
this
is
essentially means that the price is. Yeah, go ahead.
so sorry. Just to so this is each data point here, right? Is the difference between the, let's say, yesterday's candle and today's candle when they close,
Right,
or
right.
whatever the candle time
Yes,
frame is. So that's why we're
right,
getting
right,
like the kind of one is always the same. It's the if the price
right. Yeah,
remains the
this so
same,
this
it's one,
chart.
right?
Yeah. So this chart specifically actually refers to percent change. So
Mm-hmm.
this is close divided by close 1, but you would get the
Uh-huh.
same kind of chart with close minus close 1, so the previous close. So yes, 1 refers to just no change, and then below 1 is we had a down candle, and then above 1 is we have a green candle. And if we
Mm.
plot that, we can kind of see, right, that this is on average, the candle will always kind of close really close to the previous closing price. But every
Mm-hmm.
so often we'll see a week a bit higher. But yeah, we get something that looks to be mean reverting because it always oscillates around the mean. Now, what we
Mm.
got here actually is even more specific. We got something that we call stationary. Now, a stationary time series, this is essentially a term that specifies a set of data that is mean reverting and has a constant mean. Because you can also have a mean reverting data set that is not that doesn't have a constant mean. You can have something that is trending essentially. But what we got here obviously has a
Mm.
constant mean because we are always oscillating around 1.
Wait,
That's
quick
kind of the
question.
idea behind.
So how can you
Yes.
have a data set that it wouldn't like oscillate between the one? Like you mentioned trending. How does
Well,
that
you can
like
have.
what would be yeah?
Yeah, well, you can have a data set that
Mm-hmm.
always you have a kind of a base trend that is just a line going diagonally up, and then if you add some noise to that, you can say that this new data set is oscillating around that line, right? Which happens to be diagonal, but it's still oscillating around that line. Um, but but the idea is the same, right?
Mm.
If you observe a candle at a certain point, and then for the next point, the only thing that you have to keep in mind now is, well, the mean kind of also changed, right? The value around which it isolates it will also change a bit. So that's kind of the idea of just mean reversion. But in this case, we also have something that is also stationary.
Mm-hmm.
So this is a stationary time series, and if we could trade this, that would be great, right? Because we can assume that the price will kind of always move back to that mean, which is 1. And what we could do is simply buy down here and maybe even here, and all of those weak, like we could also trade those and here, right? We could open longs here and then open shorts at the top where the price wicks up, and open short is there, and then profit immediately once the price kind of moves back to 1. So that would be great, right? But unfortunately we can't really do that, because the price, when we observe this, the price is already gone, because we're essentially comparing this to yesterday's price and can't really make this actionable. If you try to, you would essentially try to predict tomorrow's candle color. which we don't really know how to do, which is, I mean, at that point, you're essentially trying to predict the direction of the price itself, which is not really a great idea. So yeah, we can't really trade this, but the whole idea of stationarity does make sense, and at least we got something that is mean reverting, and the idea of a strategy on a mean reverting stationary time series. Now, the idea of pair trading would be something else, really not much yet to do with the mean reverting stationary time series. The idea of pair trading would be to observe two random, well, not random, but we would observe two instruments. Let's say two random stocks, and we would plot their scatter plot, which is essentially just a price for one stock on an x-axis, so here, and then a price for the other stock on the y-axis, which is here. And then for every time t, we'll just say, okay, well, the price for this stock is here, and the price for this stock is here. So this is our new point, right? This is where we would put our new data point on this chart. So we do this for every time t, and we get this chart, the scatter plot, and it looks kind of random. Nothing really going on here.
Wait, sorry, just to clarify, the y and x axes here in the scatter plot, what are these dots? I think I missed that.
So again, yeah, on each axis we have the prices. So what we do is observe the prices at the same time for each stock. So let's say at the bottom here. So this is where the price of stock 1 is. Here would be the start, here would be 0, and here would be some other value n. We observe the price, which is here, and then we do the same thing for on the other stock on the y-axis, and then because this is at the same time, we just plot the corresponding point on a chart, and we plot that, and we do this for all of the times. So we kind of get a lot of dots because we observed a lot of data points, a lot of days in this example, right? Because we're using Apple's daily price. Well, this specifically is not Apple's chart, but the idea is the same. So when we do this, we get this kind of chart. This is kind of usually how it will look. It seems pretty random. Clearly, there is no relationship between the two stocks. It's not completely random, but we cannot really fit in a simple model to this. But every so often, we will get a chart that looks like this. And there is clearly something going on, because we can kind of describe this with just a line, right? We can fit a line to this thing, and just say, yeah, this model kind of is described by this line, and will be pretty accurate. And this is, we can kind of understand this, right? Because Apple and Microsoft, there are two stocks, which obviously those are different companies, but they are in the same financial sector, so they are dependent on the same kind of factors. So obviously they'll have some kind of connection between them. So this is what we want, right? We want two stocks that are kind of integrated on the same level, so kind of dependent on the same factors, financial factors or economic, whatever kind of factors. As long as we can see this kind of pattern of the chart, this is what we are really kind of trying to find. All right, so that's cool. Now we can attempt to find kind of a model that would fit this, and we can use linear regression for this, right? In a simpler terms, we would just try to find a line that best fits this data, and use this as our model for this kind of relationship between the two stocks, right? Nothing special yet, just a best fit line here. We can write this out with an equation, which is this, right? We can say that the price of the second stock is some constant alpha plus some coefficient beta times price 1, right? This is just a normal linear equation for a line, and that kind of describes that line that we visually determine to be our model.
Yeah, so this is
we can
just
take
like
this.
how do we define the line in the two-dimensional coordinates that we just saw, right? Just to rephrase
We
that.
essentially take the price one and translate it. So we kind of expand it a bit and then add some constant, and then that describes us to some degree of accuracy. It describes the second price, right? Which is essentially this line, right?
And then the alpha and beta, what do they define? Just so that everybody's on the same
so
page.
alpha is just some constant. Alpha would be this, right? This offset from the bottom, I guess, right? Would be this alpha, and then the beta would just be the slope of this line here. How steep this line is. If we have a high beta, well, then we'll clearly see a line that is much more steep. So that's just the two variables in this pretty straightforward. Just describing a line and nothing else. So that's pretty cool. We got some kind of simplistic model going on, and we can rearrange the factors in this a bit. We can put that alpha constant on one side and the rest on the other side, and that's cool. Now, this is actually now stationary. This is so Engel and Granger, they discovered back in, I believe, 2003 that if you take two data series, so in this case prices, if you take two of those and you know that they are kind of integrated on the same level, so dependent on the same factors, that if you find a specific linear combination of the two, you will actually get something that is stationary. And we can see this from the equation because we know that alpha is a constant. Well, it clearly has to be stationary. And in reality, we'll actually take, instead of prices, we'll take returns, and we'll take the log of those returns because it kind of scales the whole thing nicely. But this is really kind of the details, not really important. The point is just that this will still be stationary, right? Even the returns have to be integrated on the same level. And just if you just do a log transformation of the two, we should really not change much. And we still have something on the other end, so that alpha that should be stationary.
Okay, and then in this like going not zooming into the log, but like let's take those two stocks, so the Microsoft and the Apple. Like, what does it mean for them to be stationary in this context?
Well, the two prices are not stationary. We're not assuming on the previous slide. We just said, yeah, price one and price two, but the two are not actually stationary. They're not stationary, but Engel and Granger, they found out that if you have two non-stationary data series that are integrated on the same level, so in other words, they are dependent on the same kind of socioeconomic factors, well, then the resulting linear combination of the two, so price two minus beta times price one, should be stationary. So what is on the individual factors on the left are not stationary, but what we got at the end is, you can look up. There's plenty of content, plenty of papers and stuff like that on the Engel and Granger method. So there's plenty of stuff about that. You can definitely read more. But all that we really care about here is that alpha is stationary, and this is from the definition itself, because alpha is a constant. We know that it is stationary, and yeah, as I said, if in practice, when we actually do want to trade with this stuff, we usually take returns and the log of those returns and use that instead of the prices. But the idea is the same. So what we just found here are two co-integrated instruments. And this, again, in other words, this is just what I've been talking about. So co-integrated just means that we were able to find two instruments that are integrated, so dependent on the same socioeconomic factors, and we can find a specific linear combination of the two that result in a stationary time series. So yeah, that's simply cointegration. Just a note here that two cointegrated assets are not necessarily correlated. This is strictly different. They usually will be, but this is not a condition. If you test for correlation, that you will not actually prove cointegration and vice versa. There are a couple of examples you could find on the web where it finds where people find cointegrated series that are not correlated, as well as correlated series that are not cointegrated. But this is just a note.
So just as I'm guessing somebody would be wondering that what is the difference between correlation and cointegration, like Stats 101?
Yeah, well, correlation just simply means that two assets are going to move in the same direction. So if they are not correlated, that essentially means that one asset will do something completely different and random compared to the other asset. Like sometimes it may go up and the other will go down, and sometimes they may go in the same direction. But overall, if one goes up and one goes down, or I guess if one goes up, it doesn't necessarily mean that the other is going to go up or down. But if they are correlated, then you can kind of assume this will be the case. But correlation is not really it's not necessarily a fixed property of two series. They may be correlated at a certain point, but then the correlation is going to break. So that's correlation. Cointegration, but as I said, is simply just the ability to find two integrated prices or returns, I guess, and those and if you find a specific linear combination, that it will actually find something that is stationary. So yeah, quite a different definition, but quite a similar word, I guess. Yeah, all right. So yeah, we've determined that we got something that is stationary, but in our equation we actually see that alpha is a constant. But if we observe this chart again, we can see that we just described this line. The reality is quite a bit different. We can see that you have quite a lot of noise and quite a lot of like, I guess, residuals from the line, right? If you can see that this data here is quite a bit distance from the line, and then this data here, and I guess all of this data here is below, and then we have some of it above again. So this model doesn't perfectly fit our perceived reality. But we can fix this. So let's go back to our model. We will just simply expand this alpha factor at the end there, and describe it a bit better. So what we can do is just rewrite that as some new constant u, and then some independent, normally distributed random variable. So this, in other words, this is just some constant u plus some noise, right? And this is exactly what we see. We have a, let's go back here. We have a line. Let's say this is our constant, right? And then we add some noise. So either it's the actual observed data point is going to be a bit above or a bit below the actual line. So yeah, that actually fits our model much nicer. So I did that. This is an example from FTX. I took two pretty much random assets. This is a bit more down the line, but I took two pretty much random assets, computed the linear regression, and then plotted the so this new what I like to call a synthetic asset. And we can see that it pretty much looks stationary, and so it is mean reverting, and this is exactly what we would like to see. The code below is simply just a snippet of what you would want to write to perform this linear regression, and it's simply just using the ordinary least squares method for literally just the best fit line that you can fit onto the data that you put it in. You can look this up more, but
Yeah, and just to recap, the ordinary least square, it draws the line in a way that the dots go in the most, like, let's say, smallest difference from the line,
yeah,
right?
so the
Something like
distance
that.
between the line and the actual observed data points is the smallest, essentially. This is kind of what that OLS method does. So yeah, we from this snippet we can see here at line 4 we get this factor b, so our beta, and then after that we say a spread equals data 2 minus b, so beta times data 1, and this is this, and then we plot that spread, so our synthetic acid, and this perfectly fits our model now because we can see this is definitely mean reverting because it oscillates around 1. And we have a lot of noise, which is actually tradable. So how would we trade this then, right? How do we even take this synthetic acid, take this spread, this noise, and how do we turn this into trades? Well, the idea is simple, right? On the image there is already some lines here, and we can see that at the bottom there we have green lines and the top have red lines. So the idea is basically when this synthetic acid hits those green lines below, so let's say here, we would go long, and then when it hits the lines above, the red lines, we would go short, and then just make the difference of in prices. So when the synthetic acid moves back down, this will actually result in profit. But yeah, it's not really exactly clear how we would do this. Let's see. Well, the idea is, so as I said, we would long this synthetic asset when the price is below that observed mean, and we would short when it's above the mean. And we can then expect this to mean revert because let's say we know that this thing is stationary. But we don't really know what long and short means in this case. Well,
Yeah.
yeah, we can actually, turns out that we can take this beta that we computed before with the linear regression, and we can actually position ourselves in a way that will actually result in a position that is equivalent to longing or shorting that spread. So what we would do is we would long, to long that synthetic asset, we would buy one long contract of instrument 2 and then buy beta short contracts of instrument 1. And we would do the same thing for a short position, but just the other way around. We would buy one short contract for instrument 2 and then buy beta long contracts for instrument 1. Or in other words, we would simply open a hedge between the two instruments with the hedge ratio of beta. I guess a note here would be that the beta needs to be reverse transformed. So if you remember before, we took the log of those returns, and we actually want to observe the real beta, not the logarithmic beta. So the inverse transformation here would be we would take the exponential function and just put that beta in there, and we get the real beta that is needed to open a proper hedge. Yeah.
So what is it actually, the hedge ratio be in opening the hedge? Like, is there is there another way to kind of phrase it, a bit more simplistic term? Like, what does it mean to
Yeah.
hedge these instruments?
So hedge, when you open a hedge, let's say like the simplest example here, a hedge would be if you have if let's say you trade on a futures exchange, and you can buy a certain asset, and then let's say we buy $100 worth of Bitcoin, and then we go on a futures platform, whatever that may be, and then we can do and we can short $100 worth of a Bitcoin futures contract. And essentially what we did seems kind of counterintuitive, because like we went long on Bitcoin, but then also went short on Bitcoin. So naturally those positions cancel out. This kind of sounds counterintuitive, but you actually can make money from this in case you know there is a pricing inefficiency, which is exactly what arbitrage does. If those prices don't move, right, in the same way, like if Bitcoin goes up 2% and the futures contract also goes up 2%, well, you didn't make money. But if the Bitcoin the Bitcoin you bought, so you went long with, if that goes up for 3% and the futures contract only goes up by 2%, well, then your short lost less than your long gain. So you immediately made 1% profit, which is this can be exploited in various ways, but in our example here is essentially just used because it turns out that if we position ourselves in this way, so open this kind of hedge, that we will end up being able to profit from that spread being either so high or so low. You can like this can all be checked, obviously, but for the sake of simplicity, I'm just implying that this is true. Feel free to test it though. Like, you should always do your own research here. So yeah. But yeah, it turns out that we can just use this beta as our hedge ratio and position ourselves between instrument 1 and instrument 2 in a way that will profit at the end. So yeah, we'll basically in the end be able to with this stuff we'll be able to go short at the top and then long at the bottom where those green lines are, and then immediately once the synthetic asset moves back to the mean, we'll just close the position. In here on this image, just I guess a note is that the yellow lines in the middle here, they represent the level above or below which the synthetic asset must be in order for you to break even from the fees. Crypto is quite a bit expensive to trade on. Exchanges take a lot of fees. So yeah, this at least in crypto has to be taken into account. And so yeah, when this synthetic asset gets back into that yellow kind of area there, you can also just close your position, and there you go. You just made a little bit of profit. But as we can see, this spread actually moves outside of those bounds quite a lot. So there's a lot of opportunities. So on average, even though that you'll be making very little amount of money, you will be able to do this quite a lot of times.
We had a, sorry, I'll quickly interrupt. We had a question about, so when do you exactly buy and sell instrument 1 and 2? I think maybe let's do small recap on that.
Yeah, sure. So
because this synthetic asset consists of 2 different instruments.
Yeah. So
right?
this, yeah. This asset, this is we can see this below here, right? This asset is actually, as we can see here in this line here, where spread equals, we say data 2 minus b times data 1. So this is actually a combination, a linear combination of the 2 assets. This is no actual asset that we can trade on an exchange. We cannot sell or buy this asset directly. It is synthetic. We made it for ourselves. So you have to position yourself between the 2 assets, right? The 2 that you use in a correct way before you can actually profit from this. So what you do is, let's go back here. So here are the two options, right? To long this synthetic asset, you would buy 1 long contract of instrument 2, so instrument 2, and then you would buy beta short contracts of instrument 1. So this is if we want to long it, right? So this is exactly down here, right? Here, when this price goes far enough down, we would buy asset 2, so instrument 2, and short instrument 1 or beta worth of instrument 1, and able to profit from that, and then vice versa for shorting. So we would short asset or instrument 2, and then long beta worth of asset or instrument one. Yeah, and one.
So does it, just to give a quick, like more concrete example. So let's say we'd have like $50, both Microsoft and Apple. And let's say Microsoft drops, the value is 100 in total today. And tomorrow, Microsoft stock plummets and it goes so that it's only worth $30. So would this be kind of a similar situation that the synthetic asset that would consist of both Microsoft and Apple in the beginning the price would shift somehow, the relationship between them? So that's where we would do the buying and selling, right?
Right. Yeah. One. So yeah, this essentially has to happen, right? If two assets kind of move in tandem, right? If they move in the same manner, right? If one asset goes up 2%, when they are cointegrated, you would also expect the other asset to move up, right? We don't know what's the difference. Like we don't know if it will move for just 1% or maybe it will move for 5%. We don't know, but we need to find that relationship. So that beta, we do this with linear regression. But it's hard to give with this information. It's really hard to give the exact like what would the positioning be, because we don't know what the relationship is, right? In the model that we kind of determined it before, we said beta, but we don't know what the beta is. So if we have $100 and we want to put $50 on Apple, well, yeah, well, we don't know which asset we're comparing to. Like the Apple stock could be data 1 or it could be data 2, right? It is really a lot of different combinations that you can kind of do here. And then the concrete example really comes down to what ends up actually working. But really, you're able to, once you get to the point where you have that linear combination, so you encode, right? You already executed that linear regression and you are able to plot the spread. Well, at that point is no longer a problem, because instrument 2, that data is saved in data 2, and then instrument 1 is saved in data 1. And then we just follow the rules that we kind of have set out here. So for long and short positions, the synthetic asset, if we just follow that, it will just all be done for us. We don't have to worry about concrete examples as long as we understand which asset we're kind of comparing against here, and what beta means. Yeah, no, I hope this kind of makes a bit of sense. But yeah, there is. I'll give some points where you can kind of read more about this stuff later on. All right. So yeah, but we still haven't fully answered how to actually do this, right? We kind of answered what cointegration is, how to actually get the model, and how to trade this, but we don't know what to pick, which pairs to pick. I kind of already had an asset, or I guess 2 assets that we can trade, and that happens to be cointegrated. But we kind of have to determine that as well. We can just observe 2 random assets and go from there. So what we have to do is basically do 3 steps here. First, we need to see which assets are available to us. So in case of FTX, there are 60. Think about 60 assets that you can trade on that are perpetual assets. So in their futures platform, there are about 60 contracts that you can trade. And what you have to do is just take every single combination of those assets, which is quite a lot, and then test all of those for cointegration. After that, you have to run linear regression on that. So if you know those pairs are cointegrated, whichever are, because, well, not all of them will be, you have to run linear regression on that. And then at the end, when you actually get the beta and compute that synthetic asset, you have to test for stationarity, because if that synthetic asset is not stationary, well, then you cannot really assume that it will mean revert at the end, right? You cannot assume that. But that's cool. That seems pretty hard the first look, but lucky for us, there are plenty of libraries that actually do this for us already. So, and then one of those is stats models. I kind of used it with for that linear regression before, but basically you can use it for anything statistics related in here, and I use it basically exclusively for this stuff. So for cointegration, really what we have to do is not worry about math. Cointegration at this point really has to only be some kind of abstract thing that we really don't understand at base, because we don't have to. Well, surely you can go and look why it works and how it works in terms of math, but just to trade with this, well, you only need to know how to use that stats models library, which is easy enough because, well, it's well documented. So yeah, don't worry about math. That, I guess, is step one, even though that it is literally the last point on this slide here. But after that, there are kind of a few points here you also need to keep in mind, which are that you want to test this on a bit lower time frame than daily. Generally, this whole cointegration relationship between the assets should work on, well, basically any time frame that you throw at it. But if you do this on a daily time frame, well, then there will be quite significantly less opportunities which you can like put your money on and actually make profit on. So my advice would be to test this on a lower time frame. You also want to use a rolling window because cointegration is not a fixed property either. Just like correlation could break at any point, right? Two assets could be correlated for a while and then suddenly they are not anymore. The same is true for cointegration. So you want to do this with a rolling window, which essentially means that you take the entire data set and just move in. We have a look back period, let's say 2 hours, and then you move in steps of, I don't know, let's say 1 hour, and then test those 2 hour windows for the entire data set and figure out for that 2 hour window, is that part cointegrated or not? And you do this for all of the assets. So that's quite a lot of testing and will take quite a lot of time to do this. But generally, that's kind of what you want to do. And there's this third point here. We'll discuss this now, but essentially, TLDR is that the cointegration test doesn't test for stationarity, but actually tests for not stationarity. I mean cointegration. It actually tests for no cointegration. But let's see how and why. Well, so cointegration test. If you run that, we'll get something called a p-value. A p-value just kind of tells you how certain is that test, right? How certain can you be that that test did actually turn out to be either true or false? And for the sake of an argument, here are two examples. Let's say that you observe the two p-values from the cointegration tests. One is 0.99 and one is 0.01. And if you remember from before, the cointegration tests for no stationarity. So what you want is a low p-value, because that essentially means that, well, there's a low chance of this not being cointegrated. So a 0.99 p-value essentially says, well, this is likely not cointegrated, so that's not good. But if you have a low p-value, well, then it is unlikely not to be cointegrated, which is what we like. We want something to be unlikely to not be cointegrated, which sounds a mouthful, but
difficult.
But yeah, in other words, it is likely to be cointegrated. I'm just trying to phrase this in the correct way, because the test doesn't explicitly tell you that this is likely cointegrated. It just says, yeah, it is unlikely not to be cointegrated. Now you do the thinking, right? You do your judgment. So that's just a note here. But yeah, we like low p-values. And yeah, so I made that. I ran those a lot tests. I ran about 900 of them. And yeah, we got this heat map that we can see on the right. And so the coloring is dependent on the p-value. You can see the very most red part that is cut off at 0.01, which essentially means there is a 1% chance of this not being co-integrated. And then the very bottom is basically 0. So this heat map is basically every single combination of every single tradable futures contract on FTX.
Okay, I gotta say, so there's a couple very interesting ones here. Is it like there's a couple of these like full-on red lines for the entire asset? So it means that they're not co-integrated with anything, right?
Yeah, it is quite interesting. But we have to keep one thing in mind here. This is just an average over the entire history, right? We said before that the cointegration is not a permanent property of a pair, right? This is just an average. It looks nice, but it doesn't really tell us much. It just tells us on average, it does seem there's a lot of cointegration going on, at least on FTX. So this is good, right? Because if we only saw a couple of green dots, that would possibly indicate that that we just observed so many pairs that that we just by accident discovered a few that are maybe cointegrated, but probably not. You're much better off by getting this kind of picture where there's a lot of green, because then you're sure that, okay, well, something is certainly there. But this is still not enough, right? We tested all the combinations through the entire history and just put out the average, which is not what we want, because, well, cointegration is transient. So yeah, this just looks fancy, but not really what we want. What we want is this let's see, is this horrendous image. This is, yeah, it looks pretty bad. But essentially what this is a breakdown of every single test, right? On the y-axis, we see, well, we don't see because it's not even readable, but it is every single combination of those assets. It is a lot of them. And then on the x-axis, it's simply just all of the slices that we tested. And you can see at the very end, it's actually at the number 660. But in reality, this image is actually a bit longer. So it's more like 1,500, something like that. But either way, this essentially means this image kind of shows every single slice, that 2-hour slice, and if it is co-integrated or not, right? For every single pair, through the entire history. Now, some of this kind of parts are kind of shorter, and some of these are longer, and this is just because the history of not every asset is listed for the same period of time. So short, naturally, like some of them will be shorter. But this is good because a lot of this is just a lot of green. Though some of them kind of have certain periods which are just a lot of red, but the majority of it is green. So that's pretty good to see.
What's the, like, if the green thing is like, if some parts are like shorter lines, right? So is it because there's just less data available during that time?
Essentially less data.
Okay.
Yeah, because so I think the very first, so the very top, that short part, I think this is Aave contract against every other contract. But because Aave has been listed for such a long, short period on FTX, it is just a really short slice. But then after that, we have a certain contract that has been listed for a longer period, so it stretches through the entire image. So yeah, but the coloring is the same, right? We can use the same scale as we used here. So green means highly unlikely to not be co-integrated, and red means highly, or I guess a bit more likely to not be co-integrated, but still pretty likely that we are fine. I just used such a low p-value as my actual cutoff point. Because when you test so many assets, well, you're bound to be wrong at some of them, right? If you have 1% chance of being wrong, well, with 900 tests, well, you'll have 9 assets that are definitely not cointegrated, but the test said that it is sure as hell that they are. So that's kind of why I used a much lower p-value than a 0.01. But this is still good because we have a lot of green. We know there's a lot of opportunities to actually trade this. But this is just cointegration. There are a lot of other filters, mainly the test for stationarity, right? Not all of those series are then also going to be stationary, and then we can add some other fancy stuff on top of that. But yeah, either way, like this basically covers cointegration. Linear regression, we already did that with this snippet here, with the ordinary least squares method. And for stationarity, we have this same kind of test. It's called augmented decay filter test, and it does the same thing essentially. It returns a p-value, and you want that p-value to be very low because it tests for no stationarity instead of actual. It is stationary, right? So when it's a low p-value, then it is unlikely to not be stationary. So yeah, those are the tests. We if we kind of follow those 3 steps, we are almost there. And when I personally ran a lot of those tests, I ran about a test over about 2,000 crypto pairs on FTX and now also Binance, and only about 10 or 20 of them were tagged as actually tradable at any given time. I have a few other factors that are also taken into account. For example, if Bitcoin is cointegrated with something, well, clearly then you cannot also cointegrate Bitcoin with some other assets because, well, you already trade Bitcoin with something, so that asset is gone, right? So the number actually quickly goes down much quicker than you would expect. So yeah, the actual number of tradable assets is not all that green stuff. It's usually much less, and yeah, this is exactly the case. I found about 10 or 20 of them that could actually be traded. Now, all of that should obviously be done on bid and ask data, not actual closed data, because, well, yeah, you're not going to be trading based on the closing price. You're going to be trading based on the order book price, which, well, assuming you want to use market orders to enter, well, you'll need to keep in mind that you are entering based on the bid and ask prices and not the last closing price. And all of my systems are written in Python, so they kind of are really fast, but all of this can be done in Python. If you're proficient in Python, which is simple enough, this can all be done there. So this is it's pretty easy to kind of begin experimenting with this. As far as data is concerned, you can get this data on CCXD, or if you're not really ready to get your own data and manage your own data, this data is also available on the ChainSlayer platform, and you can use that to kind of get started, because really what you only need is like a notebook that you can run this on and kind of start experimenting. So that kind of covers, hopefully, that kind of covers how to do this. But there are still a lot of open questions, where to go from here and so on. So let's finish with that. Well,
awesome.
Yeah, so our method, we can kind of ask ourselves, well, is our method actually a good is it good at estimating the hedge ratio? Ordinary least squares method is completely fine, but there are plenty of other stuff that you could be trying, and then the main thing that you should probably look into once you get that working is our common filters, which are a pretty nice thing to have for that as the alternative. The other question is, can we assume the relationship of a pair and that it will actually hold while we trade it, right? In our example, we had a 2-hour data window, right, the look back period, and then we traded for another hour, assuming that nothing will change. But is this a good assumption? Well, probably not. Probably want to test this as often as possible so that you get, if the relationship breaks at any given point, that you exit as soon as you can. You also want to determine what's actually the best time frame to trade this, and what's the best data window. So I guess the look back length, right? I was using 2 hours on the 1 minute time frame, but is this actually the best time frame or the look back window? So to determine this, you need to do a lot more testing, or you could actually avoid those variables entirely with some other method. I think common filters kind of do this kind of, but not really. So yeah, a lot of those variables, I guess, can be eliminated, but yeah, it really depends. Do we need to account for order book spread? Yeah, if you trade on a low time frame, definitely. But if you go on a hourly time frame, or maybe even the daily, you're probably fine. But again, this kind of has to be tested, because all of the back tests, like, they can be super great, but really when you go into production, it starts to break down. So a lot of testing is needed here. We also don't know how to actually pick the pairs, right? We know how to determine which pairs are tradable, but if you have more pairs than you are physically able to trade, how are you going to pick the most profitable trades, right? We don't know yet. This would also need to be fixed in some or another way. You could be limited either by rate limits or something else. Really, there's a lot of factors that could be limiting you, performance, bottlenecks, or something like that. And yeah, I could always miss something, right? I tried to cover a lot of stuff, but I only have an hour, so yeah, there was a lot of stuff left here that was definitely not covered.
Yeah.
And even if you have a system, there's always a chance of you just being wrong. So yeah, there's always be skeptical of your system, I guess, is the notion of that last question. But yeah, that's about it.
Yeah, there was one question from Chris Arlington earlier. Oh, sorry, I cut off into your.
I mean, my animation, no, it's just a thing. Yeah, no, it's nothing special. That's really it for me. I'm just putting a shameless plug here to follow me on Twitter or add alpha into your Discord. Nothing special. But yeah, let's. You said there's a question, so I'm happy to answer that.
Yeah, there was. So I saw that Chris had a question about like the entry and exit of getting into the positions here. Like, what's exactly the system?
Well, the simple. Let's scroll back. We'll have to scroll for a bit here because there's a lot of stuff has happened since. So let's find the first. Oh, there we go. So the idea for exit, once you are already in the position, the idea to exit would basically be once you get back to the mean is your exit point. So if we just draw a line at 1 or around 1, like those yellow lines, the idea would just be to exit at when this synthetic asset kind of comes into that area. You could also say that since this is mean reverting, and if the price kind of went down quite a lot, for the mean to stay constant, you would also assume you could assume that the price is going to overshoot a bit, and this is really kind of what often happens. Here at the end, you can see that here, if we enter a short, we can see that the price then overshoots down. So you could actually enter a close your short even lower than at the middle here. But yeah, the idea is to exit your position as soon as the synthetic asset mean reverts, essentially, because that kind of resets it and then opens it back to start doing its noisy kind of like movement here.
And what about the entry? Like, when is it just like on the first red line, or do you backtest it, or how do you kind of figure out what's the best position to enter?
So the idea would be because we don't really know how far this can shoot up or shoot down. Like this can basically go as far as it likes. So I mean, it is highly unlikely that it will overshoot super high, but there is a certain level that is still highly likely to be reached, and that's why the idea initially in this image was to kind of scale in. So the closer red line, for example, would open a small short, and then if the price goes even higher and hits the second red line or even the third red line, you would kind of either open another. So you would open a bigger short, or you would double down, or something like that. Or I guess this in this case would be double up. But yeah, the idea here would be to scale into your position for every crossover. But you can also just use a single entry. Those lines specifically are placed at significant standard deviation levels. So I just calculated the standard deviation of this entire data stationary time series, and then said, okay, well, the first red line is going to be at the second standard deviation, and the next one is the third, and then the last one is the fourth, and vice versa for the green lines, right? It's standard deviation. The first green line would be at the -2 times the standard deviation, so the minus second sigma, and then the same for the other ones. But the positioning really here is up to the one actually developing this. So there are probably plenty other ways to actually enter this. And the whole idea of this basic approach is that you can take this as I described it today and just put it in the system, and you're actually likely to be profitable. But you can actually take this as a building block and build on top of that and complicate this as much as you want. You can start using some machine learning in here, predict the volatility or something, and then scale based on that, or whatever. Like you can really go over the top here and then really not hold back, because really this is just the starting point for such a strategy.
Yeah, definitely. It's infinite. The complexity can grow infinitely, basically here. That's
yeah, definitely.
So we had sorry, we that a bit on a question on what should we be looking in terms of just like drawdowns, Sharpe ratios, Sortinos on these type of strategies, and how about risk management?
Like, yeah.
Complex topics, but you know.
Let's try to cover them really quickly. Yeah, sure. So yeah. So in terms of how to measure this, obviously I haven't included any kind of back tests in this presentation. And this is for a reason. Well, because there's a lot of markets, there's a lot of time frames, and there's a lot of different other variables that you can take into account before actually making a back test. So really, like, my back test won't tell you much. But as long as you have some form of consistency in terms of your trades, which because this is a pretty low risk trading strategy, because you're always hedged if the market just does some random stuff, and right, if the two assets kind of moves together, you're not really exposed to the price itself, right? You're only exposed to those inefficiencies. So if you really want to properly risk manage this, you would first need to determine where do you want to get stopped out, and you could use a really high sigma value for this. So something that is highly unlikely to get hit, but if it does get hit, you surely know that something is wrong. You could also observe your ROI, and if the ROI just starts consistently dumping down, then you also know that you may potentially want to halt your trading for a bit and see what's going on. And then in terms of actual position sizing, I kind of used one contract of the second instrument, and then beta contracts of the first instrument. But you could actually as long as those are in the same kind of ratio, you can have bigger or smaller orders. But how you would determine how big you want to bet on a certain pair is like, there's a lot of ways to determine this. But the idea here is not to bet on something because you're sure it's going to happen, but it's just to make as many bets as possible. Because even if the bet is wrong, well, because you have so many bets and the statistics is on your side, well, then it will just average out over a certain period of time. So you're actually probably fine. It only kind of just breaks down if you are not testing correctly, and if the cointegration and stationarity doesn't actually hold, in which case, yeah, then you have a problem. But I mean, if nothing else, you'll really see that in your balance sheet, because it will start taking a clear downtrend, which should not be the case here most of the time. In terms of ratios, so the Sharpe ratio and Sortino and whatever, well, look, I have never seen a single person agree on why they use a certain ratio over another, and some just don't like them straight away. So I don't know. Use what you prefer, really. Like same with the tests, right? The stationarity test, I use the augmented decay Fuller test, but there are other tests that test stationarity. So really, it's like pick your own favorite. If you feel comfortable with the kind of what the tests give you and what I guess the ratios tell you about your strategy, then I guess that's fine. As long as you can observe profit, I think that's okay. But yeah, then if you're trying to optimize, then it's a different story, and this really goes down a very deep rabbit hole at that point. So yeah, let's not try to get into that, because we'll never end.
Mm-hmm. Yeah, yeah, that's a short in a nutshell answer for that. So I see we have a couple more questions. We are almost running out of time, so I think we can, let's see. So do quick answers. So we had one more about, could you please explain that green chart, which is the slide after heat map? So there was, I think that was the probably the
sure.
slices.
Let me go back to that. Yeah, so this thing. Yeah, so it's pretty messy chart. It's not even that high resolution either, so it's not totally understandable. It's hard to read, but essentially the x-axis is the test. So the kind of it's basically time, right? You take a lot of 2-hour snapshots in the price, 2-hour slices in the price, and for each of those slices, you test it for cointegration, and then whatever is the result, you plot that on the chart. And clearly there's a lot of those tests going on, because the 2-hour data window is quite a short period compared to years worth of pricing data on 1 minute chart. So this will obviously be a lot of stuff going on. But essentially on the x-axis, we just display every single snapshot or every single slice of the price, that 2-hour slice that we tested on. And the y-axis is simply every single pair that we are able to get from all of the available instruments on a particular exchange, in this case FTX, right? So we would start with in this case, I know it's Aave, and we would compare Aave to every single other asset. And if we look at this chart actually here, this is essentially kind of the first. Oh, actually, let me take this here. So it's this. Oh no, that's not the right one. This. So for Aave, we would test every single one of those squares here. In this line here, we would test every single one of those for every single 2-hour slice that we can get through the entire history. And so this is this part here at the very top, kind of hard to draw there. But yeah, I mean, it is a shorter period, meaning because, well, Aave is not listed for a while. But yeah, in terms of what it tells us, this chart specifically is basically the same as this heat map here. The scale is the same, right? The greener the chart, the more likely it is that the series or that snapshot or that slice of price is co-integrated, right? And every pixel essentially on this chart represents one test. And if it's green, well, then it is likely co-integrated. If it's red, then it's probably not. And we can see there are certain areas where it's kind of red. Like here, we can see a lot of kind of red sections, stripes going through the entire kind of bar-like thing. And these parts, I guess, were not co-integrated with that specific asset. So yeah, this is in short, this is just co-integration tests on 2-hour slices over the entire price history on all of the pairs that are available to us. Yeah, hopefully that makes a bit more sense. But if not, like I'm also I'm available on Twitter and then Discord all the time, so feel free to reach out and we can discuss this further.
Yeah, I think you're online like all the time, basically.
Yeah, I'm way too long. Like Discord is basically open 24/7. This is not okay. I need to. Yeah, it's all right. Well.
Yeah, we got and in the Slayer chat we got a statistical arbitrage group. So if you guys are into this, I highly recommend join our Discord. We're gonna be we have weekly calls and meetings, so you can meet, I think, both of us, at least me most of the times, and you know, Mathis, you're there quite often as well.
Yeah.
And yeah, it was Twitter is at MacoAlgo, right? And the alphabet system, which is very nice in terms of I think it's like it's very cool, like the most advanced Twitter, sorry, Discord bot for the financial data. It's really cool. So guys, check that out too. And I wanted to, like, at the end share a bit from we have also a community instance for our community members. I just wanted to quickly show that, so that if you guys want to get your hands dirty with this data, it's possible and it's very accessible as well. So I'll just show it quickly once I found out where's the share screen button. Okay. Okay, there we go. So if you guys like what Mathis has been just telling you, and you want to get started, we have a free available community instance where you can select the data that you want, upload it into a database. So it's pretty simple. Just by selecting whatever data set that it is you want to have, you can just add it and upload that to the database pretty simply and get started. So we have our community members are doing their own scripts and their own stuff that they can help each other to learn and become a better trader. So we've got a bunch of tutorials here, and you can also make your own workspace. So just make a folder there and your own workspace if you want to join. So just wanted to kind of share that with everybody. And this is all public. So in case you do want to have your own instance privately running with all data sets available, you can subscribe to a private instance, which you can use as you want in our website, chainslayer.io. And just at the end, we have a limited discount. So if you click the button and you do a word called arbitrage. So if you type in arbitrage there, you're going to have a 50% discount for the first 3 months, which is only limited for people in these webinars. So a bit of a promotion there from our side at the end, but the community instance, I highly recommend to check it out. Guys, come to the statistical arbitrage meetings because those there you can ask much more details from Mathis as well. How do I? Yes, and now it's stop sharing. Yeah,
There we go.
so that was that. But hey, it's been really awesome. Honestly, very nice presentation. So much insight here.
Yeah, I'm happy to hear that.
Yeah,
Like
it's
I just
been,
said, I'm
it's
available for
truly,
any other questions. If anyone has any, reachable on Twitter and Discord always. So feel free.
yeah, awesome. So I guess, yeah, you can talk to us in the community, reach out to us, and I hope everybody has a very nice weekend. And yeah, see you next time then.
See ya.
Awesome. Bye bye.